My name is Alex Morgan, and on January 29th, 2026, I was watching my screen at 9:47 in the morning when something happened that I genuinely did not expect to see in my lifetime. Gold, the metal that has been humanity's store of value for 5,000 years, touched $5,595 per ounce, a number that would have sounded like science fiction just 18 months earlier. The trading floors were electric, headlines were exploding, analysts were tripping over each other to raise price targets. And then, in less than 2 hours, almost $2 trillion in market capitalization simply vanished. Not gradually, not over days, gone, just like that. What you are watching right now is the anatomy of that moment. Every trigger, every hidden mechanism, every institutional decision that turned history's greatest gold rally into one of the most violent single-day crashes in commodity market history. And more importantly, what it tells us about where gold is headed from here. Because there is a version of this story where the crash was a bubble bursting, and there is a version where it was the greatest buying opportunity of the decade. The data will tell us which one is true. Let's get into it. To understand what happened on January 30th and 31st, you have to understand what kind of market gold had been operating in for the 12 months leading up to that moment. Gold's spot price had risen 96% in the 12 months leading up to January 28th, 2026. That is not a bull market. That is a supernova. And when you zoom out just slightly further, the picture becomes even more extreme. Between Trump's inauguration and the end of January 2026, gold prices had nearly doubled, while silver prices had risen nearly fourfold. The entire precious metals complex was running on fumes of euphoria, parabolic momentum, and one of the most crowded institutional trades in modern market history. And crowded trades, when they reverse, do not reverse gently. The single most important thing you need to understand about the crash is this: it was not random. It was a perfect storm of 5 simultaneous triggers hitting at the exact same moment, and each one amplified the others. Let me walk you through each one, because understanding the mechanics is what separates investors who panic from investors who profit. Trigger number 1, and by far the most powerful, was a single White House announcement. That euphoria evaporated instantly with the announcement that former Fed Governor Kevin Warsh had been nominated to succeed Jerome Powell as chair of the Federal Reserve. Warsh, known for his hard money stance and his high-profile 2011 resignation in protest of quantitative easing, represents a stark departure from the accommodative policies of the previous decade. Within minutes of the news, algorithmic trading programs triggered a massive liquidation in GLD and SLV. Think about what that means for a moment. Gold had been running on a debasement trade, a bet that the Fed would keep printing money, that the dollar would keep weakening, and that hard assets would keep outperforming. Warsh is the exact opposite of that thesis. He is a man who literally resigned from the Fed in 2011 rather than support more quantitative easing. His appointment did not just slow the gold trade down, it put a flamethrower to its core assumption. When the market learned Warsh would be in charge, investors panicked and sold. Gold dropped 12% to around $4,900 per ounce. Silver crashed 30% to $85. This was the worst day in decades for both metals. Trigger number 2 was a mechanical one that most retail investors never think about: margin requirements. The CME raised gold futures margin requirements from 6% to 8%, forcing leveraged traders to sell immediately. This is not a small thing. When you trade futures, you do not put up the full value of your position. You put up a deposit, the margin. When the exchange suddenly demands more of that deposit, you have 2 choices: put up more cash immediately or sell your position. In a market already moving against you, most traders sell. And when thousands of traders all hit sell simultaneously, the price falls faster, which triggers more margin calls, which triggers more selling. This is how leverage becomes a self-reinforcing avalanche. Trigger number 3 was the calendar itself. February 1st, 2026 falls on a Saturday, meaning futures markets would not reopen until Sunday evening. Traders holding January contracts or facing month-end margin requirements had no ability to adjust positions over the weekend. This created a compressed window where all position adjustments had to occur on Friday, and month-end rollover activity amplified selling pressure dramatically. Every trader who needed to close a position, roll a contract, or meet a margin call had a single window: Friday, January 31st. The result was a complete one-direction market with no buyers to absorb the selling pressure. Trigger number 4 was pure profit-taking at historic scale. In January 2026 alone, gold prices jumped more than any time since the 1980s. Many institutional investors in Wales were sitting on triple-digit gains from the previous year. The hit to record highs of $5,600 acted as a sell signal for major players looking to lock in profits. Once the selling started, it triggered a liquidation of leveraged long positions, forcing the price even lower. This is called a crowded exit, when everyone decides to leave at the same moment and the door is too narrow. The result was not an orderly reduction of positions. It was a stampede. And trigger number 5 was the most underreported, a shift in physical demand from China. When the Shanghai Gold Exchange began trading at a discount to the London price, what analysts called the Shanghai flip, it signaled that real-world physical demand in the world's largest gold market could no longer support the inflated paper prices being traded on Western exchanges. When Shanghai goes to a discount, it means Chinese buyers are walking away. And when Chinese buyers walk away, the physical floor beneath paper prices disappears. All 5 triggers hit simultaneously, and the result was the most significant single-day decline in precious metals markets in over 4 decades, gold dropping more than 12% and silver crashing 31.4%. Now let's look at what happened in the aftermath, because this is where the story gets genuinely interesting. Despite the severity of the collapse, something unexpected happened almost immediately. The dip got bought. Major institutional investors treated the crash as a buying opportunity. GLD saw $2.6 billion in net inflows during January alone, a record, according to World Gold Council ETF data. BRICS-aligned central banks in China, India, and Turkey were significant buyers during the dip to $4,700, providing the support needed for gold to bounce back to the $5,100 level. By the end of February, gold had reclaimed $5,100, still down sharply from its high, but recovering with conviction. The buyers who showed up at the lows were not retail panic buyers. They were sovereign wealth funds and central banks, treating a 12% discount on the world's reserve asset as a gift. Standard Chartered's Suki Cooper, who leads the bank's global commodities research team, said she was not surprised by the sell-off since both metals were trading in aggressively overbought territory in the early weeks of 2026, and that both markets were due a correction, particularly to maintain the long-term uptrend. That phrase, to maintain the long-term uptrend, is the key to understanding what this crash actually was. It was not the top. It was a cleansing of speculative excess that had built up during one of the most vertical monthly rallies in commodity history. Healthy bull markets periodically purge weak hands. This was a purge. The mining sector tells a particularly revealing story. Newmont Corporation and Barrick Gold saw their share prices crater by 14% and 12% respectively during the initial rout. Despite the dip, both companies remain fundamentally robust due to their high-grade assets and low all-in sustaining costs, which allow them to remain highly profitable even at the $5,100 level. For investors who had chased these stocks as gold moved towards $6,000, the losses were compounded by the volatility of the mining sector's equity risk. The crash has created a value hunt, where disciplined cost management will be more rewarded than simple production growth. Junior miners with weak balance sheets that were being priced as if $5,500 gold was permanent have been severely punished. The majors with low production costs are emerging from the correction in fundamentally strong positions. Now the question that every single person watching this video is actually thinking: what happens next? Where is gold going from here, and what do you do about it? The bear case first, because intellectual honesty demands it. The broader significance of the crash lies in the breakdown of the de-dollarization trade that had been a tailwind for metals. The sudden strength of the dollar, combined with the Shanghai discount, suggests that the global liquidity environment is tightening faster than markets anticipated. A truly hawkish Warsh Fed, one that commits to quantitative tightening and holds rates higher for longer, would maintain dollar strength and create real competition from government bonds that pay meaningful interest while gold pays nothing. If that scenario plays out in full, gold's path back to $5,500 is not quick. But the bull case is significantly more compelling right now. JP Morgan analysts have stated they expect gold to reach $6,300 an ounce by end of 2026, saying gold remains a dynamic, multifaceted portfolio hedge, and investor demand has continued to come in stronger than our previous expectations. Bank Julius Baers Matthews noted that gold's 2 fundamental drivers remain unchanged. The US dollar should continue to depreciate, and central banks should increase their holdings in gold. UBS and Deutsche Bank project gold recovering to $6,200 per ounce by summer 2026, citing that geopolitical dangers, fiscal deficits, and central bank buying have not changed. Historically, after panic selling, Prices recover within 2 to 3 months as calm returns to the market. The U.S. national debt has grown to $38 trillion. Central banks from China, India, Turkey, and Poland are still buying massive amounts of gold. Geopolitical risks persist globally. None of those structural realities changed on January 31st. The Warsh nomination changed the near-term rate outlook. It did not change the fiscal trajectory of the United States, the de-dollarization ambitions of BRICS nations, or the irreversibility of a world in which sovereign nations are quietly reducing their exposure to dollar-denominated assets and replacing them with something that has no counterparty risk. Diego Franzine, head of portfolio strategies at Plenisphere Investments, put it most precisely. In a world where almost every financial activity incorporates credit risk, that of a state, a central bank, an intermediary, gold remains the only asset without a counterparty. It makes no promises, pays no interest, and is not dependent on political decisions. It simply exists, and that is precisely why it provides security. That is what the January crash actually tested, and the answer came from central banks, sovereign wealth funds, and institutional buyers who treated the dip as a clearance sale. The debasement thesis was not destroyed on January 31st. It was momentarily challenged, and the market's response to that challenge will, I believe, look in hindsight like one of the most important data points of the decade. If this video gave you a clear picture of what actually happened and where we go from here, drop it in the comments. I want to know whether you think this was a top or a buying opportunity. Like the video, subscribe if you want this level of analysis every week, and I will see you in the next one. I'm Alex Morgan. Stay sharp.